Okay, good morning, everyone. I welcome you all to today's training section, which is on financial planning and bookkeeping. I believe everyone can hear me. Can you hear me, Manasseh? Yeah. Okay, so today's course objective is before us, and it's expected that at the end of today's training session, you, the participants, should be able to, among other things, one, understand what we mean by financial planning activities. To differentiate long-term from short-term plans. We'll tell you how long-term plans differ from short-term plans in the course of this session. 3, understand reasons for bookkeeping, the main reasons why companies keep their financial records. 4, identify bookkeeping methods. We should be able to tell you the various bookkeeping methods that you can adopt as an entrepreneur or business owner. 5, show you also how to record your financial transactions in case you decide to maintain your financial records independently. And lastly, we'll see how we can balance the books. But our understanding is that most people may not have accounting background or knowledge, so we'll see how far we can go. But emphasis on this session is basically financial planning, how to plan our finances, and how to keep our records, our books of accounts, financial records. So let me start off by telling you this. You can't run a healthy, successful business without having your books in order. It's not possible for you to run a healthy and successful business when your financial records are not in place. Any attempt to do that will be likened to a driver who drives a car without a fuel gauge. And you know what happens when somebody drives a car without a fuel gauge or fuel map? Sooner or later, the driver discovers that the fuel is finished. He has run out of fuel or gas, and the car will be forced to be pushed aside or to be pulled away. The same thing, this same analogy applies to businesses. We are saying that you cannot run a healthy and smooth business if your financial records are not in place, and if you fail to plan your financial activities. So financial planning is very key, very critical to the success of every business. Likewise, bookkeeping activities. So let's start off by looking at what we refer to as financial planning. Financial planning is a plan needed for estimating the fund requirements of a business and also determining the sources for same. When we talk of financial planning, it is that activity that involves estimating or identifying how much in terms of naira and kobo that is needed for the proposed business of yours to be set up and to thrive. That's what we refer to as financial planning. And having identified the fund requirements, how much in terms of naira and kobo that is needed for the business to be established, financial planning also gives you an insight into the sources for the fund. It's not just enough that we have identified how much is needed for the business to be established. You need to also make effort to identify the sources, where the money or where the funds will be gotten from. Like most of us who have identified the source of our funding to be NISA Microfinance Bank, if I'm correct. So all of this activity is what we refer to as financial planning. So financial planning essentially includes generating what we call a financial blueprint for your company's future activities, where you design a financial blueprint that tells you how the business, how the company should be run in the future. We say you have engaged or indulged in financial planning activities. So here are objectives of financial planning. These are some of the reasons why companies, why entities, why entrepreneurs like you may have to engage in financial planning activities. One, to ensure availability of funds. When you engage in financial planning activities, you are basically ensuring that funds are readily available for your business to thrive. That's the number one reason why financial planning is so important. And secondly, to estimate time and source of funds. The reason why financial planning is so important is it helps you estimate the timing and the source of the money, the fund that is needed for the business. So the timing of the money, when should the funds be taken? Timing is very critical, very important, because a rational businessman or woman, a rational investor will always want to take up funds or make investment at the appropriate time, what we call the right time. So if you take up funds when the time is not right, you only discover that you end up paying for what we call finance charges or borrowing costs when the fund is not needed. So the timing is very important in order that you minimize or keep to the barest minimum the borrowing cost, the finance charges. Of course, we know that for every fund that is taken up for injection into a business, there is what we call borrowing cost. There is what we call cost of funding. There is what we call finance charges. The banks or the National Microfinance Bank will not give you funds at 0% interest rate. No, nobody does that. So the only thing is that you may get the funds at a lesser interest rate. Or even at that, you still need to plan to be sure that these funds are taken when you are ready to commence the business operation, because it makes no sense holding funds and bearing interest charges when you are not ready to venture into that business. So timing of the fund is of essence, and that's the more reason why financial planning is so important. Then the sources of funds, you need to also identify where the funds will be gotten from. It's so critical, it's so important. Who are you relying on to have these funds available for the proposed business activity? Most of us, like we said, our sources of funds is National Microfinance Bank. Yes, so meaning you have identified the source of your funding. Then thirdly, generating capital structure. Capital structure is so important for every business entity. What do we refer to capital structure? Capital structure means the separation of your total fund injection between what we call debt and equity. Equity is the fund that is contributed by the owners of the business, the shareholders. So any amount that is injected into the business by you, the investor, you, the ordinary shareholder, that amount we refer to it as equity, funds contributed by owners of the business. But the portion that is not contributed by owners of the business, rather it is borrowed, like the amount you have to take from National Microfinance Bank. That fund is what we refer to as debt or liability, as the case may be. So the total fund injection into your business is usually separated into two. Can either come in the form of debt, meaning the amount you have borrowed, or it comes in form of equity, the amount you have saved over time and injected into the business. So it is so important that you generate a very good capital structure for your business. In most cases, we advise that the fund contribution by you, the equity participants, you, the shareholders, should be more. It should be more than the amount that you are borrowing. The amount that you are borrowing. So always ensure that the fund contribution by you, the business owner, is always greater than the fund being borrowed. This will help to minimize pressure on your business, because there's always a pressure where most of your funding or your capital for the business has come through borrowing. It puts the business into risk and pressure, risk of liquidation, risk of insolvency, risk of takeover when you fail to make repayments at the appropriate time. So capital structure, deciding on the proportion of your capital, total capital that will be equity, and the portion that will be debt. Then lastly, the objective of financial planning is avoiding unnecessary funds. The reason why companies engage in financial planning is to ensure that funds are not held idle. You don't hold funds idle. No rational investor will want to hold funds when the funds are idle. You want to hold funds when you need it, when you want the fund to revolve in your business. So, like I said earlier, every fund injection into your business has cost of borrowing, cost of capital. So it will be totally irrational for you to have funds, you are incurring interest charges on it, meanwhile the business is yet to commence. So you have to plan and avoid unnecessary funds from being tied up. So these are some of the objectives while companies, while individuals engage in financial planning activities. Okay, financial planning. Financial plans are of two types. Financial plans are of two types. We have the long-term financial plans and the short-term financial plans. The long-term financial plans is sometimes referred to as strategic financial plans. So it's either we say long-term financial plans or we say strategic financial plans. Long-term financial plans consider a number of financial activities which include but are not limited to one, proposed fixed asset investments, research and development activities, marketing and product development, capital structure, sources of financing. Let me try to explain. Any activity that borders on proposed fixed asset investment, how a company intends to finance its fixed asset investment, that plan is basically a long-term strategic financial plan. What is fixed assets? Fixed assets are those resources owned and controlled by an entity which the entity uses for its sales generation or generation of what we call future economic benefits. So when you have any assets within your company which you use to generate future economic benefits, and the future economic benefit here is your sales. So any item that helps you make money, to earn money, earn sales, and that item is expected to last over one accounting year, meaning that item, that asset can live beyond 12 months. It means that asset is what we call fixed assets. Some people call it long-term assets. So fixed asset investments. Let me give you an instance. Imagine if you are into farming and you are considering the acquisition of a tractor. The tractor in this instance is a good example of fixed asset because the tractor will definitely be used in generation of revenue or sales for your business. So if you are considering how to purchase this tractor and you have to draw up options or plans that borders on whether this tractor should be bought outrightly, that's if you have the liquidity to buy it outrightly, you just walk up to any vendor, you pay cash, and the tractor is delivered to you, or the plan specifies that your company should buy it on what we call hire purchase, finance lease. So all of these plans, because you are considering on the acquisition of tractor, which is a fixed asset investment, it therefore means that that plan is a long-term strategic financial plan. Then secondly, research and development activities. The act of trying to develop a product or a prototype for your business before production commences at a commercial quantity. When you are trying to make progress, develop new ideas, new products, any amount you spend there, we call it research and development cost. So these research and development costs or activities falls under long-term financial plans. Capital structure, like we explained before, we said trying to break down your total capital between debt and equity. So any plan trying to decide what proportion of your total capital will be contributed by you, the shareholders, or the equity participants as debt, as equity, sorry, and what the balance is that will have to come in form of borrowing. The act of trying to do that means you are engaging in long-term strategic financial plans. Then deciding on the sources of funds, where your funds will be gotten from. Should you approach NASA Microfinance Bank? Should you approach any of the commercial banks? Should you approach any of the CBN accredited lending institutions? So trying to decide on the sources of funds, sources of financing your business. Those plans, those activities border on long-term financial plans. So basically, how do you know that a plan is of a long-term strategic financial plan? You can use the number of years or the period that the plan covers. If a plan addresses concerns of 3 years and above, you do know that such plan is a long-term strategic financial plan. So when you draw plans that will help you attain certain objective in the next 3 years or beyond, it means that plan is a long-term strategic financial plans. So these long-term strategic financial plans are generally supported by a series of annual budgets and profit plans. So what we're saying here is that even as you draw up your 3 years, 4 years, 5 years, or even 10 years plan, which is known to be a long-term plan, you still need to produce the annual plans so that these annual plans, when aggregated, will still give the same result or effect that the long-term strategic financial plan is meant to give. So if a plan is not a long-term financial plan, it is definitely a short-term operating financial plan. So short-term operating financial plan is the opposite, direct opposite of the long-term strategic financial plan. So for a short-term operating financial plans, they specify short-term financial actions and the anticipated impact of those actions, and typically they cover 1 to 2 years. So when a plan covers activities of 1 to 2 years, you do know that such plan is a short-term operating plans. Plans, maybe you are making plans on how your inventory will be managed. You are making plans on how your debtors are those customers who buy on credit from you, how they will be managed. Maybe you are drawing up a policy that allows a credit for as maximum of 2 years, as maximum of 1 year, as maximum of 2 months. That policy, that plan you have drawn up at that particular point in time is short-term operating financial plans. So basically, how to identify that a plan is of a short-term operating financial plans is considering also the period that the plan is meant to address. So if your plan addresses concerns of 1 to 2 years, you do know that such plan is a short-term operating plan. But once the plan has a period of 3 years and above, plan is meant to address issues up to 3 years and above, then know that such plan is a long-term strategic financial plan. So take notes. Another distinguishing factor between long-term financial plans and short-term financial plan is the period in which these plans cover. If the period is up to 3 years and above, then it is a long-term financial plan. Anything less than 3 years, maybe perhaps 1 year or 2 years, definitely know that it is a short-term financial plans. So we have said that financial planning is so important, very critical to every business operation. It is also important that we know that there are certain tools that may be used in achieving these financial plans. The objectives of these financial plans can be achieved using certain tools. Those tools include cash budget. Draw up cash budget in order to plan and manage our finances, just like we have a normal regular budget at home in our family. Most people have budget that before you spend, you have to budget for it. Before the salary comes, you have drawn up budget so that it gives you a clear-cut direction how the fund is to be spent. The same thing applies to businesses. When you carry on your business, it's expected that you drop your budget to give you clear-cut direction, the kind of income you're expecting, where the income will be gotten from in a particular period, and the kind of expenditure you expect to undertake. So cash budget will help you address that. What then is a cash budget? Cash budget is a statement of a firm's planned inflows and outflows of cash. So any statement of any entity that clearly itemizes all the inflows in terms of sales, all the income that the company receives, that's what we call inflows. Then on the other hand, the cash budget aggregates all the total cash outflows, total expenses, cash expenditures that are made. That statement that itemizes both these inflows and outflows is called a cash budget. A cash budget. So cash budget, basically, companies prepare cash budgets in order to put them on guide, to help them not to involve in what we call extra budgetary activity. So that when before you spend, you consider if those expenditures have been properly budgeted for. And if it has not been budgeted for, the next question to ask is this expenditure relevant or not? And if it's not relevant, you may have to forgo the expenditure. But if it is relevant, even though it has not been budgeted, you may have to incur the expenditure. So budgeting keeps you, the business owner, on guide to prevent unwanted expenditure. That's what budgeting does. Not only expenditure, it helps you to identify potential revenue earning activities where you can earn your revenue, your income, so that you can rigorously pursue them as time goes on. So cash budget is used to estimate short-term cash requirements with particular attention to anticipated cash surpluses and shortfalls. So when we prepare cash budget, it helps us to identify if the company has enough cash at its disposal or not. And don't forget, this is only called a budget, a cash budget, meaning that at the end of the day, at the end of the financial year, you may discover that the budget may tend to differ from the actual result. Maybe that an entity has budgeted that its total revenue for a particular period, maybe 10 million. And after the end of the year, maybe perhaps the entity realized only 8 million. So there could be variances, but the budget is so important, so useful that it will help in preventing unwanted expenditure, extra budgeted expenditure. So cash budgets can either be prepared monthly or annually. So you can draw up your monthly budget, and the monthly budgets are then aggregated to produce the annual budget. So here is a typical budgeting cycle before us. This is a very typical budgeting cycle. For you to carry out your budgeting activity, you need to go through this cycle. One is what we call performance planning. You plan your performances first before engaging in your budgeting activity. One is performance planning. And when you plan your performances, you are simply identifying the goals, the objectives for the business for that particular period. What is your goal for being in business? What is your objective for being in business for a particular period? You may have a goal that, oh, this year, you want to dominate the market, a particular market. Perhaps you operate a tuition center. Your goal may be, oh, this year I want to dominate the Abuja market. So that is your goal, that is your objective. Another person, maybe a farmer, may have another goal that, oh, this year, after the end of the farming season, I want to have a certain number of outputs as harvest. So Those are goals, those are objectives that have to be established first during the budgeting cycle. Then having identified the goals or the objectives under the performance planning, you go ahead and provide a frame of reference. A frame of reference is identifying a benchmark that supports your goal. Benchmark in the sense that you need to set realistic goals. Take, for instance, I have said, oh, after the end of the farming season, I want to have, say, 10 tons of maize. But that 10 tons of maize must have come from a reliable measurement. 10 tons of maize, meaning at least I should have farmed 5 hectares of land, because averagely 1 hectare of land gives expected yield or of output of 2 tons. So if on average, having confirmed from those who have farmed before, those who have farmed maize, those who have cultivated maize before, and my finding is that 1 hectare of land can produce 2 tons of maize, it means that my goal, my objective, my plans are still in place. The essence of providing a frame of reference is such that your goals are attainable. It will be totally baseless when your goals are unattainable. You should have attainable budgets. Attainable budgets. Like you may see somebody, another person may say, oh, at the end of the farming season, I want to have 10 tons of maize. Meanwhile, the person has only cultivated on 2 hectares of land, making that budget unattainable. It is practically impossible for you to harvest 10 tons of maize from 2 hectares of land. So you have to provide a frame of reference by using benchmark and making inquiry from those who have conducted that activity before in order for you to have attainable budget. And the third one is the budgeting implementation proper. You go into budgeting implementation. You implement the budget, you go into budgeting implementation, which in this case is the farming activity. You go into the farming activity. After the farming activity, you now investigate variations where there are. If there are variations, you investigate them. Remember what we said before, that there will always be variation between your budget and the actual results. What you are budgeted for may differ from what the results, the actual results are. So it will leave you with variance. So imagine we have said we want to at least have 10 tons of maize. And after the farming season, after the implementation, we discovered that we only had 8 tons of maize. Of course, there is variance between the projected 10 tons and the actual 10 tons. So that leaves us with what? Variation. Investigating this variation, we want to probe further. Why was it that this thing was not possible? The 10 tons of maize was not possible. We need to probe into the possible reasons. Would it be that planting was done late? Would it be that the wrong farm implement was used? So these are the investigations that you may have to launch. Okay, so after this, we'll go into corrective actions. We take corrective actions. Corrective actions to hinder or forestall the reoccurrence of the adverse budgets we had, adverse results we had. So corrective actions could be ensuring that you plant earlier next farming season, ensuring that you use the right farm input or farm implements the next farming season, and all that. So these are some of the corrective actions that you can take. After that, you plan again. Budgeting is a continuous process, is a continuous cycle that after the end of a particular budgeting cycle, you review the outcome and compare it with the objective you earlier set, and you plan again. So this is the typical budgeting cycle that we are all expected to follow. So we have what we call strategy, planning, and budget. Strategy, planning, and budget. There are basically two types of strategy. We have the long-run strategy and the short-run strategy. Long-run strategy and short-run strategy. Long-run strategy is sometimes referred to as long-run budgets. The short-run plan is referred also as short-run budget. So depending on the type of strategy that you have for the business, you may adopt the most appropriate tool for addressing it. For instance, if you have a long-run plan, a plan that spans over 3 years and above, like we said earlier, you may consider using the long-run budget. I mean, a budget that is prepared to address your financial issues budgeting up to 3 years and above as well. So if you have a short-run plan, a plan that you want to achieve within the next 12 months, within the next 1 year, you may have to draw up your short-run budget. Your budget will concentrate on a period of 12 months. That's one financial year. So cycle of money, that is what we call cycle of money. The primary function of finance is the movement of money from lenders to borrowers. Money tends to move. Money tends to move. And this is what we refer to as cycle of money. So the fund moves. The fund moves. Every fund that is injected into your business tends to move. If eventually you're able to get the funding from NISA Microfinance Bank, discover that the funds will move. The fund comes in from NISA Microfinance Bank into your business, and you use the fund in turn to pay salaries and wages, to pay vendors and suppliers, those who provide you with one form of goods or services. The fund that initially came in from NISA Microfinance Bank will find its way out again, out of your business. And once you pay for these goods or services, you produce goods, you add value, you produce goods or services, and you sell these goods you have produced. Customers will in turn pay for the goods or services. And once they pay, you discover that the fund that has gone out finds its way back again into the business. So this is what we refer to as cycle of money. So the fund that comes into the business, into your business, finds its way out again. And when the goods are produced, the fund eventually returns back again. This is what we refer to as cycle of money. So let's shift focus to bookkeeping. Let's look at bookkeeping activities. Bookkeeping involves the recording on a daily basis of a company's financial transactions. Remember, we said at the beginning of this session that any attempt for you to run your business without having your financial records in place, without keeping adequate books of accounts, you will be likened to the man who drives a car without a fuel gauge. And once you drive a car without a fuel gauge, your fuel finishes, may be forced, the car may be towed, the car may be pushed aside. So the same thing, this same analogy applies to running a business, owning a business without proper books of accounts. So with proper bookkeeping, companies are able to track all the information on its books to make key operating, investing, and financing decisions. When you have your books in place, your financial records in place, you're able to take key operating, investing, and financing decisions. We call them strategic decisions. Books of account that you have maintained will help you take these decisions, and it puts you ahead of every other person, especially your competitors. So bookkeepers are individuals who manage all financial data for companies. Bookkeepers, those who maintain these books, we call them bookkeepers. So it's expected that if you can afford the services of a bookkeeper, good. The services will be most beneficial to your business. You engage them and they maintain these books of account for you. But if on the other hand, you consider the business too little, too small, you cannot afford the services immediately, there are ways you can maintain your financial records, even as non-accountants. So before the end of this training session, I will show you how to maintain your financial records, even as non-accountants. A simplified way of maintaining your financial records. So without bookkeepers, companies would not be aware of their current financial position, as well as the transactions that occur within the company. When you don't have bookkeeping in place, you will not know your current financial position. You will not know the worth of your business. You will not know if the business is making profits or losses. So that's why bookkeeping is so important. So let's consider the objectives, the importance of bookkeeping. These are some of the reasons why companies engage in bookkeeping activities. Number one, bookkeeping provides a reliable measure of a company's performance. When a company maintains its books of account, the company is able to measure the company's performance. The company is able to assess if profit or loss has been made in any particular financial year. So that's what bookkeeping does. It tells you if there has been improvements in your performance or not. Secondly, bookkeeping provides information for strategic decision. Like I said earlier, you have appropriate books of account in place, you're able to make key strategic decisions. Let me give you an instance. Some of these strategic decisions may be involved in farming, and perhaps you farm two crops. You farm maize and you farm yam. So because you have your books of account in place, at the end of the farming season, you have maintained the books separately for these two segments, the yam segment and the maize segment. So you may want to take or assess the profitability, the return that each of these segments has brought, to see whether it's the yam or the maize that is bringing enough returns than the other. So after the farming season, you check your records, you only discover that the yam has brought more returns than the maize. So you may take a strategic decision by deciding whether to discontinue the maize cultivation and shift focus and resources to the cultivation of yam. So these are some of the strategic decisions that you can take when you have your books of accounts in place. So these are some of the strategic decisions. Then thirdly, provides benchmark for revenue and income goals. Bookkeeping will help you benchmark your revenue, your sales, your income. When you maintain your books of accounts, you clearly see your revenue earning activities, and it helps you pursue them rigorously. Sometimes because we have books of accounts that we maintain in any financial year, the next year we want to pursue those revenue earning activities. We ask ourselves and say, this man that gave us this man that helped us earn revenue last year, let's check up on the man, let's push, let's try that entity and see if anything comes out of it. That's what bookkeeping does. It helps you to benchmark your revenue and income goals. Then fourthly, fulfillment of legal and tax obligations. Some companies, especially in this part of the world called Nigeria, most companies, most SMEs maintain their financial records, their bookkeeping, simply because they want to comply with tax. They want to fulfill their tax obligations, simply because FIRS is after them. They need to file, they need to maintain their financial records. So when you have your books of accounts, your financial records in place, you are able to comply with legal and tax obligations. You're able to file your tax returns. I've seen instances where startup companies were coerced to paying taxes even when they are not liable to pay tax. Any company that is less than 3 years, the company records loss within its first 3 years. That year that the company records loss, the company is exempted from tax payments. Yes, that's the tax law. But you see companies, even within their first 3 years of operations, still pay taxes. Reason being that they have no records, no financial records to substantiate their claim that they have actually made losses. At least when you go to the FRS, you claim that you have sustained losses for the year, and as such, you should be exempted from tax payments. tax authority will want to see proof. That proof is your books of accounts that has been maintained. So for you to substantiate the proof, you need your financial records in place. So it is very important that we maintain our financial record in order to help us fulfill our legal and tax obligations. Then the fifth one is providing stewardship to investors. Discover that in modern day business, the investors differ from the managers. The managers are those who are entrusted with the day-to-day administration and running of the business, while the investors are the shareholders who have contributed or brought their money for the business to thrive. And the investors expect what we call returns on their investments. So the only way that the managers who engage in the day-to-day administration and running of the business can render accountability, can be accountable to the investors, is by providing their books of accounts. So that's why bookkeeping is so important, so that managers can clearly communicate in financial terms how the business has fared over the period that they have managed it. Then lastly, proper management of cash flows. When you maintain your financial records, your books of accounts, you manage your cash flows properly. Your cash flows are better managed because you have a book of accounts for it. So these are some of the importance, the objectives why companies engage in bookkeeping activities. Now let's look at accounting basis. That's what we call accounting basis. Accounting basis refers to the time when accounting transaction is to be recorded. The time when accounting transaction is to be recorded. That's what we refer to as accounting basis. So basically, there are two bases of accounting. Two bases of accounting, the cash basis and the accrual basis. The cash basis tells us when a transaction should be recorded, while the accrual basis tells us also when transactions should be recorded. The point here is that a company may decide to use either the cash basis or the accrual basis. The choice is yours. You may decide to use the cash basis or the accrual basis. Now let's look at the basis one after the other. The cash basis. Cash basis of accounting advocates that transactions should be recorded only when cash is actually received or paid. In other words, you are expected to record accounting transactions when cash is actually received or paid. So emphasis here is on cash movement. Because as the name suggests, cash basis, you record transactions only when cash has exchanged hands. So if cash comes into your business, you record that transaction. You record it in your books of account. If cash leaves your business, you also do what? You record it in your books of account. You record it in your books of account. That's what we mean by the cash basis. So in this case, if you make sales on credit, you sell to a customer on credit, even though the sales transaction has taken place, but the fact remains that the cash has not been received by you, and as such, you will not record that transaction, especially when you use the cash basis for accounting. So under the cash basis, accounting transactions are recorded only when they are actually received or paid. Only when they are received or paid. So like we said earlier, emphasis here is on cash movement. Then the accrual basis takes the opposite turn of the cash basis. Under the accrual basis, transactions are recorded when they occur, even if they are not received or paid. So if a transaction occurs, you record that transaction, regardless of the fact that the money may not have been received or paid. Let me give you an instance. You buy goods on credit from your customer. If you buy goods on credit from your customer, the fact remains that that transaction has occurred, because for your customer to release his goods to you, it means that transaction has occurred. But you are not making payments now. And for the fact that you're not making payments now, the transaction has occurred, and as such, you have to record it under the accrual basis of accounting. Emphasis when we use the accrual basis of accounting is on the occurrence of the transaction. Once the transaction has occurred, you go ahead and record the transaction. But if the transaction has not occurred, you don't record the transaction. So, like the instance I gave you, having to buy goods on credit, and the goods are supplied to you. For the fact that the goods have been supplied to you, it means that transaction has occurred. And under the accrual basis, you do what? You record it. Even though you have not made payment for those goods. That's the accrual concept. But when you use the cash basis, emphasis is on cash movement. Even though you are bought on credit, it is only when you eventually pay the supplier that you record that transaction in your books of accounts. So I just hope that we have understood the difference between the cash basis and the accrual basis. So here is an example before us. If you purchase 100 units of products and you will pay for it next month, you have purchased 100 units of products and payment will be made next month. So under the cash basis of accounting, you see, because payment will be made next month. So no transaction will have to be recorded. You don't record any transaction under the cash basis of accounting. But if it is the accrual basis that you have adopted for your business, transactions will be recorded for the fact that the transactions, those goods have been supplied to you, record those transactions. So the difference between the two of them is that one recognizes transactions when cash moves. Either cash comes into the business or cash leaves the business, and that is a cash basis. While the other, which is the accrual basis, does not place emphasis on cash movement. Rather, it places emphasis on the occurrence or non-occurrence of the transaction. If transactions occur, they are then recorded. But if they don't occur, you don't record them. So I need to stress this, that if your first year of operation, maybe 2021, you commence your business, you have chosen to use the cash basis in the year 2021, it's expected that years to come, 2022, 2023, and years to come, you will continue to use the cash basis. If you adopt the accrual basis of accounting in your first year of preparing your accounts or maintaining your records, it's expected that in future years to come, 2022, 2023, you should stick to the accrual basis. In accounting, it is totally forbidden for any company to use one basis. Maybe you use cash basis in a particular year, this year, and next year you switch to accrual basis. It is totally forbidden. It's not permitted. Any attempt to do that will make your financial statement incomparable. It becomes incomparable. Take note. So here are methods of bookkeeping. We have the single entry bookkeeping method and the double entry bookkeeping method. Remember, at the beginning of this session, I told us that before the class is over, I will show us how to maintain our financial records, even as non-accountants. There are ways you can maintain your books of accounts. The single entry bookkeeping method is a straightforward method where one entry is made for each transaction in the books. So for the single entry bookkeeping, you make your transactions, only one entry is made, one entry is recorded. So let me give you an example how you can maintain your records even as non-accountants. You can have, like I've seen people, they open what we call analysis column cash book. It's sold in this bookshop. You can buy analysis column cash book. It's a long book, wide. It has several columns, and you can use it to record all your transactions, so that one column can be for maybe your salaries, expenses. The other column can be for your transport expenses. The other third column can be for repairs and maintenance. The other column can be for your utilities, so on and so forth. Okay, I see I have several charts. Let me check. Okay, somebody's asking, can one not use both bases? Somebody asked a question. Can one not use both bases? Two people have asked, and I've said it. Clearly, you are not permitted to use the two at once. You can either choose to use this the aqua basis, or you cannot use it for you. If you can hear me now. Okay, so the two bases of accounting, you're only permitted to use just one. If you decide to use the cash basis, it's expected that you use the cash basis all through the life of the business. If you decide to use the accrual basis, it's also expected that you use the accrual basis all through the life of the business. So you're not permitted to change between cash basis and accounting basis as the year goes by. So let's come back to methods of bookkeeping. We said we have single entry bookkeeping method where this applies, this can be most beneficial to even non-accountants. As non-accountants, you can use the single entry bookkeeping because it is straightforward. You have the analysis column cash book from a bookshop, where you record all your transactions. You have one column, second column, third column. In fact, once you buy the book, you will see the various columns. You can decide any repairs and maintenance, I'll put them in this column. Any salaries and wages, I'll put them in the other column. Any utility payment, I'll put them in the other column. Any hotel expenses, I'll put it in the other column, so on and so forth. So that whenever you incur salaries, you go to the appropriate column and you record it on that. So at the end of the financial year, you sum the columns. You sum column for salaries, you sum column for transport, you sum column for repairs and maintenance, and you have your figures for the account preparations. That's the same single entry bookkeeping in the simplest form that you can have. While some people also, they use their bank statement in addition to their check stubs. For those of you who use checks, you can decide that before you issue checks, you record the transaction details of the check on the stub. The check stub is that small leaf attached to the check booklet. So you see some people immediately they're tearing off the check leaf, they will fill that small leaf attached to the check stub, put all the narrations and details and the amount involved and the date of the transaction. That is also another way, simplified way of maintaining your financial records. You also see some people, they just buy this hardcover notebook. You have various leaves, say, okay, this leave, I want to be recording all my sales transactions. On to the next leave, we say this other leave, I want to record all my transport expenses. That leave, I want to record all salaries I paid during the year. The other leave, I want to record all utilities and DSTV subscriptions I paid. The other leave, I want to record all telephone expenses I made. These are all simplified ways, methods of record keeping. Now let's look at double entry bookkeeping method. For the double entry bookkeeping method, it is more robust. It follows the principle that every transaction affects at least two accounts, and they are recorded as debit and credit. So whenever a transaction occurs, you have two entries to make. One of the entries we call it debit entry, the other one we call it credit entry, whenever a transaction occurs. So in this case, you may need an account clerk or a bookkeeper who has prerequisite knowledge of bookkeeping or accounts. Because only somebody who understands which accounts to be debited and which accounts to be credited that can use the double entry methods. It's only somebody who understands the double entry techniques that can use the double. So the fact we're trying to say here is that if the double entry bookkeeping will be so difficult for you because you don't have background knowledge in accounting, or because you cannot afford the services of a bookkeeper or an account clerk to help you maintain these financial records, you can simply stick to the single entry bookkeeping method. Anyone you use will still give you the same results, even though the double entry bookkeeping method is more advisable. Because it helps align and makes your accounts to be straight. Okay, accounting systems. Accounting systems are designed to collect, document, and report on financial transactions affecting business. Accounting systems are designed to collect, document, and report on financial transactions as they affect businesses. So any system that is put in place to help you collect reports on your financial transactions, that system, we call it accounting system. So accounting systems are of two ways. We have the manual accounting system and the computerized accounting system. The manual accounting system allows accounting transactions to be processed by hand. So just like the example I gave us, or the method I suggested, where you have to record these transactions on your analysis column cash book, or you record it on a hard cover notebook. By so doing, because you are recording it manually using your hand, it means you are using the manual accounting system. Using the manual accounting system. The second type is the computerized accounting system. In this case, financial information is recorded by entering it into a computer. You rely on computer for your accounting transactions or your bookkeeping to be maintained. In this case, you may need to use certain software such as Excel. Use Excel to maintain your records, to maintain your accounting system. You can also use any of these accounting packages, such as QuickBooks, Sage, Peachtree, Tally, and what have you. So because you need system to maintain these accounting records, that's why it's called computerized systems, computerized accounting system. So I want to believe that the computerized accounting system is more reliable and it will produce more accurate financial reports than the manual accounting system. Don't forget that anything that is done manually is prone to have error, But computers tend to be more accurate, provided the writing is done. Keyword here is provided the right input, right data is imputed into the system. Now, that is what we call garbage in, garbage out, GIGO. Even as computer outputs tend to be more reliable, they are not totally excluded from errors. They can still be prone to error. But the type of error here is man-made error. If you wrongly impute a data into the system, the computer may generate an output that is also inaccurate, meaning your financial report, your financial data may also be inaccurate. Your accounting reports to be generated. So that's why we have to be very careful, even when we feed this data into the system. We have to be sure that the data we are keying into the system, they are all correct and accurate. So imagine if you don't have accounting knowledge, you debit a particular account and credit the other. Meanwhile, you have done the wrong thing. You have debited and credited the wrong account. You quite agree with me that the financial reports to be generated at the end of the exercise will be wrong. So bear in mind that the computer system is not totally free from error, but the kind of error here is man-made error. And that's what we call GIGO, garbage in, garbage out. So still on the accounting system, there is what we call GAAP, generally accepted accounting principles. So what we refer to as generally accepted accounting principles are all rules, all bases, all policies, all norms, all regulations that an accountant will have to pay attention to or pay focus on while preparing financial reports. So any rule, any norm, any provisions, any standards, any regulation that an accountant will have to make reference to while preparing the financial report, they are called generally accepted accounting principles. Accountants don't just prepare accounts, they make reference to certain regulations. So there are regulatory frameworks that guide how financial statements are to be prepared. So all accountants use the same set of rules to prepare financial reports. And this set of rules are provided by the Financial Reporting Council of Nigeria, FRCN. It is the FRCN that provides these rules and mandates all accountants to use them while preparing their financial statements. So you can imagine what will happen where there is no generally accepted accounting principles for accountants to build their focus on. You, the business owner, may be tempted to declare a little profit so that your tax payment will also be little. You pay little or no taxes. So in order to guard against all of these, that's why there is GAAP, generally accepted accounting principles, that must be followed in preparing financial statements, preparing financial reports. If there is no generally accepted accounting principle, you discover that a manager whom you have engaged to run the business and the manager's reward system is based on incentive. The manager may do everything possible to do what? To window dress the account and report adequate profits so that the incentive can be earned. So in order to guide against all of this window dressing and creative accounting, that is why the Financial Reporting Council of Nigeria came up with this GAAP, generally accepted accounting principles, for all accountants who prepare the accounts to do what? To follow them, rigorously follow them. So that's what we call financial reports. Financial reports is the summarized information about the financial status of a business. Financial reports is the summarized information about the financial status of business. So the end product of our bookkeeping activities is to help us produce what we call financial reports, meaning financial reports will have to be produced from our bookkeeping activities. Emphasis here, like we have said, is on bookkeeping. Once the books of accounts have been maintained, you have kept adequate records, all the transactions that transpired during the financial year, it then makes sense for you to hand over these financial records to a qualified auditor or a qualified accountant who then produces what we call financial reports thereof. So the end product of these record keeping is to help us do what? Generate financial reports. The records the bookkeeping activity will have to be maintained first. And from the bookkeeping records that have been maintained, financial reports, such as your profit or loss account, balance sheets, statement of cash flows, can then be prepared from the records that have been kept. Okay, so business, we call accounting the language of business because it is so fundamental to the communication of financial information. Accounting is often called the language of business. When we talk of accounting, we are simply referring to documenting every naira and kobo that comes in or leaves a particular business. That's why it's called the language of business. So we have basically two broad categories of accounting reports. Two broad categories of accounting reports. We have the financial accounting. Financial accounting or financial account focuses on reporting information to external users. So simply put, any account that is prepared for external users' need, we refer to as financial accounts. So financial accounts are prepared for external users' information need. When you prepare accounts for the sole intent of external users to make reference to that account you have prepared is called financial account. While on the other hand, if accounts are prepared to provide information to internal users, those we consider to be decision makers within the business, such as the managers, the owners of the business, the shareholders, the employees, any account that is prepared because it is still within the confines of the business. The account is prepared for usage in the business, not to be tendered outside. That account for internal use is what we call management account. But the moment the account will have to be prepared to be supplied to external users, those who are not considered to be members or management team of a company, that account is referred to as financial account. What then is the difference between financial account for external users and management account for internal users? You notice that financial account is usually being audited, meaning invited to express what we call an opinion, to review the accounts before they are eventually sent outside, because external users will have to rely on these accounts. So we have financial accounts being audited, meaning that financial accounts will have to contain audit opinion, external audit opinion. While the management account, because it is not to be sent out, it's not meant to be sent out, it is strictly for the internal workings and decision making of the business. Usually, we don't have external auditor's opinion on it. So I just hope you know the difference between the two. So we have said external users and internal users. Who are they? External users are individuals outside the business who have an interest in the business. So any individual outside the business who has interest in your business, we call that person external user. Examples of external users are government. Government may be interested in your financial reports, in your accounting reports. Government in this case may be the tax authority, which is FIRS, or the FCT IRS. Government authority may be PENCOM. Imagine if you are involved in pension business, you may have to submit your accounts, your reports to National Pension Commission. If you are involved in banking activities, you have to submit your accounts to CBN, Central Bank of Nigeria. If you're involved in insurance business, your account will have to be submitted to NICOM, National Insurance Commission. So these are government agencies considered to be external users of your accounting reports. Second one is the general public. General public may be interested in your financial statement, especially if you are a PLC, just like Dangote, Julius Berger PLC, Zenith Bank PLC, GT Bank PLC, because they have their shares being traded on the floors of the Nigerian Stock Exchange. Their financial report will have to be made public. Once you are a PLC, your financial report will have to be made public. You upload it on the website of the Securities and Exchange Commission and on the company's website. It becomes a public document. The third one is the civil societies. Civil societies may have interest in your accounting report, in your financial statements. Then the fourth one is the lenders. Lenders are those who provide you with one form of funding or the other. A good example of lenders here is the NISA Microfinance Bank. If you eventually obtain this loan from NISA Microfinance Bank, NISA Microfinance Bank being your lender, having advanced you funding, will at one point in order call for your financial statement, for your accounting report. So these are examples of those we consider to be external users of accounts. Then the internal users are individuals inside the business. Example, shareholders, owners of the business, that's the shareholders. Second one is the managers. Managers, those who have been entrusted with the day-to-day running and administration of the business. They will be interested in the accounting reports to see how well or how poorly they have done in a particular period. Then the employees also, the staff, will also be interested in seeing how far they have done for the particular year. So these are some of the examples of external and internal users of financial report. So primary accounting reports, there are basically 3 primary accounting reports that is meant to be produced from our bookkeeping activities. Remember, we're expected to maintain our books of accounts, and from the books of accounts that have been maintained, we'll produce accounting reports thereof. So number one of those accounting reports to be produced from the bookkeeping activity is what we call balance sheet. Balance sheet is any statement that clearly itemizes what a business owes and what the business owns outsiders. So any statement that shows what belongs to a business in terms of its assets and what the business owes outsiders in terms of liabilities and equity, that statement is referred to as a balance sheet. So in most cases, balance sheet shows the financial position of a company. And we have balance sheet equation. The balance sheet equation is such that assets must be equal to equities and liability put together. When you have your assets, assets are those resources belonging to an entity. All assets of the company must equal the liabilities and equity. Take for instance, if you say all assets in your business, all assets within your business is worth 10 million naira. All your motor vehicle, your office equipment, your inventories, that's your stock, your cash at bank, these are all items belonging to the business. If it is valued at 10 million, it means that this 10 million would have been funded either by equity or by liability. Either you have brought part of the money to fund these assets, which is equity, or part of it has been borrowed. So in most cases, when you have the value of an asset to be 10 million, and you are told that equity amount contributed by the owner or owners of the business is given to be 4 million, it therefore means that the balance of the 6 million to make the total asset 10 million, balance of the 6 million would have come as a liability, what we call debt, a liability. Is a borrowing that you have taken. So this is a balance sheet equation. At any given point in time, liability and equity put together must equal the value of your assets. Then another primary accounting report to be generated is the income statement. Income statement is a statement that is prepared to show how much in terms of profitability that a company has made in a particular period, usually yearly. In other words, these reports are produced yearly, every 12 months. We produce a report. So income statement tells a company how much profit or loss the entity has made for that year. And how is it prepared? You aggregate all sales, all income, you aggregate it, then you minus all expenditures. So in this case, if the sales exceeds the expenses, it means the company has made profit. But if on the other hand, the total expenditures incurred exceed the sales, it means the company has recorded losses for the period. And the third one is a cash flow statement. Cash flow is a statement that is prepared to show the liquidity position of a company. Cash flow we prepare to show how liquid a company is. And what is liquidity? Liquidity is the ability of a company to meet up with its short-term debts when they fall due. Meaning, a company should be able to have some cash or some resources in its liquid form, so that when creditors, those you are owing, when they come knocking at your door, you're able to do what? To settle them or to pay them back. So liquidity here means ability to settle short-term debts when they fall due. A creditor that advances you with funding comes asking for the funds, for the repayment of the fund. If you can pay that amount really is being demanded for, it means you are liquid. Or if you don't have enough resources in your bank accounts or as cash to pay that amount when it's being demanded for, it means you are not liquid. So that's why we prepare cash flow, to show us how liquid a company is. And let's not trade or mistake liquidity for profitability. They are two different things. A company may be seen to be profitable, but that company may not be liquid. You see a company that is profitable, a company records a huge profit in its income statement, but when you prepare the cash flow statement, the company may have little or nothing in its bank account. So liquidity is quite different from profitability. So these are the three primary accounting reports that can be produced from our bookkeeping activities. 1, the balance sheet; 2, the income statement; and 3, the cash flow statement. So remember, I told us about the balance sheet equation, where we said assets is equal to equity and liability put together. So when we add liability and equity together, it definitely gives us a balance, the value of assets. If your asset is 10 million, it means the liability and equity put together has to be 10 million. If asset is 10 million here and liability is given to be, say, 4 million, it means equity definitely is the balancing figure of 6 million, because the two sides have to agree. Liability plus equity have to agree with the value of your assets. That's what we mean by balance sheet equation. For the income statement, we have the revenue minus expenses. It leaves us with profits. But like we said earlier, if expenses is greater than the revenue, it means the company has recorded losses for the period. So let's take a look at the format of a balance sheet. This is what a balance sheet looks like, a typical format of a balance sheet. If you notice, you discover that the balance sheet has two sections, the left section and the right section. The left section contains all the assets, and we have said that asset is all resources belonging to a company, belonging to this company. While on the right-hand side, we have liabilities and equities. Liabilities are borrowings. Equities are fund contributions by the owners of the business. So let's start off by looking at the assets. When we come to the asset, which is on the left section, assets are further classified into current assets and non-current assets. assets are grouped into current assets and non-current assets. Current assets, remember we said assets are those resources belonging to an entity, meaning whatever we see under this asset section is everything that this company can lay hold on, can boast of. So under the current asset records every item belonging to the entity which can be easily converted to cash within the next 12 months. So everything that this company has, which can be converted or translated to cash within the next 12 months, will have to be included as current assets. So examples of current assets are cash and cash equivalents. When a company has cash at bank at hand, it's already in its liquid form. You don't need to convert it any further. It's already in its liquid form. That's why it's included under current assets. Account receivables. Account receivables are those customers who are owing your company. If a customer has bought on credit and is owing you, we call it account receivables. Some people call it trade receivables. Those who are owing the company. And because this debt is expected to be recovered within the next 12 months, that's why we classify it as current assets. Inventory is also referred to as stocks. When you have stocks, inventory, an item that is held for resale, you have an item, maybe your farm produce you are holding for the purpose of selling them, we call them inventory or stock. For the fact that these sales, this inventory is expected to be done within the next 12 months, you classify it under current assets. Prepaid expenses. When you make payments in advance and you are yet to enjoy the services, we call it prepaid expenses. Perhaps you may pay for 2 years' rent, and the year comes to an end, you have only utilized or enjoyed the services for 1 year rent. The balance of the second year, which you are yet to enjoy, comes in as an asset, current asset. Investments. If you have investments that is due for maturity within the next 12 months, you classify it under current assets. So take notes. Those items that are grouped under current assets are those items belonging to a company and which are expected to be converted to cash within the next 12 months. Current assets. Now let's shift focus to the non-current assets. Non-current asset is the opposite of current assets. While we say current assets are converted to cash within 12 months, non-current assets cannot be converted to cash within 12 months, meaning they are assets belonging to a company which is expected to live beyond 1 year. A good example is your property, plant, and equipment. Property, plant, and equipment belonging to the business, such as land. If the business has land, the company has land, land ordinarily are expected to live beyond 1 year. Land can live for several years. And because of that, we classify it under non-current assets. Buildings also. Buildings will come under non-current assets. Furnitures and equipment. Motor vehicles, plant and machineries. These items belong to the company quite all right, but they are expected to live beyond 1 year. So they will come under the non-current assets. Then we'll have also the intangible assets under the non-current assets. Intangible assets are identifiable non-monetary items without physical substance. Identifiable non-monetary items without physical substance. So simply put, any item of a company which cannot be seen, felt, or touched, but used for the generation of future economic benefit or for making revenue, for making sales, for making income. That item is referred to as intangible asset. So when you have any asset, any item that you have either paid for or acquired, which cannot be seen, felt, or touched, but which helps you in generating revenue or income for the business, that asset is referred to as intangible asset. A good example of intangible asset is license. Maybe you may have a fishing license. Imagine having a fishing license that gives you exclusive rights to fish in a particular river. The license cannot be seen, it cannot be felt, it cannot be touched. It has been paid for. But that license helps you to generate revenue for the business. That's why it's called intangible asset. It comes under the non-current asset. Now shift focus to the right-hand section, which is the liabilities and equity. Remember, we say liabilities are amount borrowed from third parties. So liabilities are classified into current liabilities and non-current liabilities. Current liabilities are amount owed by this company to outsiders, which is expected to be settled within the next 12 months. So when your company owes outsiders and your company is expected to redeem these debts, to pay these debts within the next 12 months, that is a good example of current liabilities. Example of current liabilities: accounts payables. When you are owing a customer, perhaps you have bought goods on credit and you are owing this customer, it comes as accounts payables. So it will be placed under current liabilities. Notes payables. Maybe you have any loan which is due for payment within the next 12 months, it comes under the current liabilities. Accrued expenses. You have enjoyed goods or services either from your employees who have provided services to you. You are yet to pay them, come under the current liabilities. Deferred income. If a customer has paid you for supply of goods or services and that has not taken place, it becomes a liability, it becomes indebtedness to you, and it comes under current liabilities. So if a liability does not fall under the current liability, it definitely falls under the non-current liability. Why we say current liabilities are those liabilities expected to be settled within 12 months. The non-current liabilities are indebtedness of a company which can live beyond 12 months, meaning the indebtedness which can last over 12 months. A good example of non-current liability is loan, long-term loan. Example, the NISAL microfinance loan. If you're able to get this NISAL microfinance loan, for the fact that you will be indebted to NISAL for a period over 12 months, you categorize it under the non-current liability. It comes under the non-current liability. After the liability, we'll talk of the equity, still on the right section of the balance sheet, equity. When we talk of equity, remember we said this earlier, any amount that is contributed by owners of the business, that's the shareholders, balances belonging to them is what we refer to as equity. A good example is ordinary share capital that has been bought or subscribed by these shareholders. Retained earnings, accumulated retained earnings over the years, profit made by the shareholders yet to be distributed, they fall under the shareholders' equity. So, like we said earlier, the total assets must equal total liabilities and equity. So, if you look at the screen, you discover that the left hand, the total for the left hand column and the right hand column is equal. Otherwise, we say your account is not balanced. The two of them have to be equal. So let's quickly take a look at the format of income statement. This is what an income statement looks like. When preparing the income statement, you start off from your sales, your revenue. Your sales is expected that you itemize all the revenue earning activities or the sales earning activities during the year. If you look at the screen, you discover that this company has been able to make sales through one, client service revenue, sales of books, professional consultation. It's expected that you break down those sales earning activities. For instance, you may be involved in farming, and perhaps you have cultivated several crops. It's expected that when preparing your income statement, you should show the revenue from the several crops you have cultivated. You can say sales of yam, you put the figure. sales of maize, you put the figure, sales of cowpea, that's beans, you put the figure. So a clear breakdown like this will help users to take adequate and informed decision. Having itemized all your sales earning activities and their values, you itemize all the expenditures for the year. You can have stuff like salaries and wages, marketing and advertisement expenses, your rent, your utilities, membership and publications, insurance, office supplies, and the rest, repairs and maintenance, so on and so forth. All expenses you have incurred in order for you to earn the sales you have earned. So you itemize them. They have to be itemized. Then the sales, aggregated sales, will be deducted from the aggregated expenses, sorry, will be deducted from the total sales, leaving us with profit before tax, after which you pay or make provisions for tax. Anything that is left is called profit after tax. So this is a typical format of an income statement. I want you to observe carefully that this income statement has two columns. It has the current year column, which is 2004, and the prior year column, which is 2003. When you prepare your income statement, it's expected that you include both the current year figures and the last year figures, the comparative figures. Essence of including comparative figure is to help users of this financial statement take and make adequate informed decision. Anybody who is studying these financial records will want to see what was revenue last year, 2003, and what is revenue this year, 2004. Has there been any increase in revenue, or there has been decrease in revenue? That's why you must include the comparatives to help users take and make adequate informed decision. Anybody who is studying this account will want to see what was the profit reported last year, which is the last figure. Profit reported last year was 33,672, but this year it has grown to 41,707, indicating strength on the part of this company. So the reason why the prior year figures are included side by side with the current year figure is to help users of financial statements make and take adequate informed decision. It is so important that you include the comparative figure. Here are what we call components of accounts. The basic unit of accounting is the basic unit of accounting is an account or general ledger account. This is a unit of information that represents business records. So there are 5 types of accounts. 5 types of accounts. We have assets, okay, somebody sent me a message asking what is an operating income. Operating income is the income that is made before finance charge. Operating income is any income that is made before finance charge. So when you have your revenue, you minus your cost of sales, you have your gross profits. From the gross profit, you take care of all expenditures, excluding your finance cost. So consider all expenditure types, excluding your finance cost, and any profit you have there is called operating income or operating profits. And the moment you go further to include your finance charge, it's no longer called operating income, rather it is called profit before tax or profit for the year. I've answered this question. So here are 5 components of account, meaning no matter the account you want to prepare, be it profit or loss account, be it balance sheet, be it cash flow statement, you have to use any of these components of accounts. The 5 components: assets, liability, equity, revenue, and expenses. The first 3 components, which is asset, liability, and equity, They are used for the preparation of balance sheets. Asset, liability, equity, the first three on the list, they are used for preparation of balance sheets. While the last two, revenue and expenses, are used for preparation of income statement. That's the profit or loss account. So no matter how complex, how large a business is, be it Dangote PLC, be it Zenith Bank PLC, in preparing the account and in grouping the accounts according to components, they must be grouped under these 5 components. Must be grouped under these 5 components. So what is accounting? Accounting is the process of recording business activities that make changes to accounts. When we talk of accounting, we're referring to making changes to your account balances. A good example of those changes will occur when sales of product is made. If sales of product is made, your account balances tend to change. It means you have accounted for the sales of the product. Revenue from services end. When you account for revenue for services and your sales, your income, also your revenue balances will also change. When you buy products or services, you account for them, your account balances will also change. When you incur other expenses, your account balances will change. When you charge depreciation on your fixed assets, your non-current assets, your account balances will change. Your depreciation balance will change. The value of the fixed assets also will change. So this is what we mean by accounting. By the process of recording business activities, account balances change, their values change. So double entry, I don't want to bore us with the double entry because we said this class is basically on financial planning and bookkeeping, not on double entry activity, because most of us may not have the accounting background. But don't forget, under the double entry bookkeeping, if you decide to engage a bookkeeper or an account clerk who will adopt the double entry, we said every debit entry must have a corresponding credit entry. In other words, for one transaction that takes place, maybe for instance, you buy goods, you purchase goods for the business, that purchase will attract 2 entries, the debit entry and the credit entry. So identify which of the accounts to debit and the other to credit comes with knowledge, some knowledge of accounting. And remember we said, if the double entry bookkeeping cannot afford the services of a bookkeeper or an account clerk to use the double entry bookkeeping, you can stick to the single entry bookkeeping method. Under the single entry bookkeeping method, you use the analysis column cash book, you use the hardcover notebook, you use the check stubs. These are simplified ways of maintaining your financial records. So, like we said, anyone that works best for you is expected that you use it. So in most cases, when we talk of debit an account or credit an account, when we debit certain account, the value increases. When we credit certain accounts, the value reduces. Okay, let me take you back here. We have these 5 components of account, which is assets, liabilities, equities, revenue, and expenses. Now, the first and the last on the list, assets and expenses, usually have what we call a debit balance. Assets and expenses have a debit balance. Because they have a debit balance by default, if we debit any asset, it means the value will go up. If we do the reverse, that's by crediting any asset, the value will reduce, so on and so forth. The middle 3, which is liability, equity, and revenue. Liability, equity, and revenue. If we credit them, their values will increase because ordinarily they have a credit default balance. Since they have a credit default balance, the middle 3, liability, equity, and revenue, if we debit any one of them, the value will reduce. So, like I said, don't want to take you further into debit and credit. It's expected that if we want to use the double entry bookkeeping method, we can engage the services of account clerk, like I've said severally, or you get a bookkeeper, or you can even undertake to learn the double entry principles, knowing which account to debit and which to credit. Alternatively, you make the work easier for you, simpler for you, by choosing to use the single entry bookkeeping method, where you don't have to concern yourself with which of the account balances to debit and which one to credit. So on this note, ladies and gentlemen, I want to thank you for your audience. And the floor is now open for questions and answers. Observations, if you have observations, you have questions, I expect you to indicate by a show of hand. Either you indicate by a show of hand, or you go to the chat section and drop your question. It will be attended to. Let's do this quickly, or we take our post-lecture quiz and close for the day. The floor is now open for your questions, for your observations, for your comments. Except you are saying you have understood everything that has been said. By so doing, you demonstrate the understanding by completing the quiz. Okay, no question? Question? Do you have question? Anybody with question? Any hands up? Do you have any hands up? Raise your hands up so that we can unmute you and take questions and take your questions. You go to the comment section, the chat section, and ask your question. Okay, if there is no question, then we go into the post-lecture quiz. Okay, so the link to the quiz has been posted on the platform. The link to the quiz has been posted on the WhatsApp platform. It's expected that you make attempts, and we should return by 12:10. Okay, 12:07. Exactly 12:07 is expected that we should have finished. So I want you to hang on. You don't need to leave the group. You don't need to leave. Don't disconnect your network. Just make attempts and return. Send your answers to us, just like some of you did for the pre-lecture quiz. So we are all 13 here. Do not expect that anybody leave. I'm watching all of you. Don't expect that you leave. Expect you to hang around, make attempts on the question, and send back your answer. So I'm watching you. I'm still watching you. Okay. Okay, welcome back. We have seen your answers to the post-lecture quiz, and most of you did exceptionally well. In fact, I see people scoring 100, some scored 80, some scored 90. But generally, the pass rate is good enough. It's excellent. So I'm impressed. We are impressed. It means that we have thought and you have also listened. So we want to appreciate you for your audience, for taking part in today's training session. So for those who are yet to send in their answers, you're expected to do so within the next 24 hours, because it will be used as part of our assessment here before certificates are awarded. So, ladies and gentlemen, in the absence of any question, observation, or comment, I'd like to end the class for today so that we can return back to other activities. So hopefully, God's willing, we'll see you tomorrow, same time, 10 a.m. So on this note, I want to say thank you, goodbye, enjoy the rest of the day.